This past week, over 680 of you out there took part in a random poll we posted here. The vast majority of you deemed silver to be the best bet out into the year 2025. Today we're going to explore, while silver bets are a building consensus across the investment world, we probably all are underestimating the asymmetric potential of this bullion bet, one that at current prices has limited downside yet potential upside that requires further perspective now that we've entered a decade in which seemingly trillions are the new billions. Hello, this is James Anderson of SD Bullion. Friendly reminder that earlier this week at SD Bullion we released an over 158-year round gold-silver ratio graphic. The current GSR is still near 100 at the moment, a historically high level. But given some of the data we're about to show and discuss, it's unlikely the gold-silver ratio will stay that high over the next 5 years, and throughout the remainder of this decade for that matter. Stay to the end of this video for an update on that data, and you can also find a link to that research in the description box below. Late last month, the team at Visual Capitalist published their latest update of all the world's money and markets in one visualization. An illustration using representative 100 billion fiat Federal Reserve note value equivalent squares to give readers an illustration of the wealth in the world in the year 2020. They source data from organizations like the Bank for International Settlements, Credit Suisse Wealth Report, IIF Debt Monitor, the Private Federal Reserve, Forbes Magazine, Fortune 500 data, and other sources. Today we're going to run through a bit of this data for context where both silver and gold markets stand respectively. And two, we'll finish by giving you an update on the physical silver industry in 2020. We've done videos on this channel highlighting how much silver is in the world, research using historical data. And once we finally arrive to the minuscule silver market, we'll dig into some related silver charts to see where we are in the potential mega silver bullion bull market building. But first, back to the graphic on global wealth. Warning, many of these numbers are mind-bogglingly large. Just for some perspective to somehow better wrap our minds around the scale and size of some of these figures, when I say 1 billion seconds, that's nearly 32 years of time. Conversely, when I say a trillion seconds, that is about 31,700 years of time. That is about 400 human lifetimes of difference. The U.S. budget deficit in this year alone is projected to hit 3.8 trillion. That is well more than double the previous record set following the 2008 financial crisis, a 1.41 trillion budget deficit in the year 2009. Meanwhile, the Federal Reserve has announced open-ended asset buying programs to support the economy, which will add even more to its currently exploding 7.2 trillion balance sheet. Oh, and by the way, the U.S. national debt just passed 26 trillion this past week. We can expect 30 trillion perhaps sometime in early 2021. Derivatives top this list of largest asset classes, and estimates of derivatives can be as high as 1 quadrillion or 1,000 trillion in notional value, according to a variety of unofficial sources. However, because of the non-tangible nature of derivatives, the value of them gets measured in two different ways. The larger notional value represents the position or obligation of a contract, while gross market value measures the price of the derivative security itself. It's a subtle difference that manifests itself in a huge numerical way. Examples of derivatives include futures contracts, forward contracts, options, warrants, and swaps. This illustration has gross market value of derivatives at only 11.6 trillion versus a notional market value of anywhere from 558 to 1,000 trillion total. Moving on to a breakdown of total global wealth, 360 trillion according to Credit Suisse report is spread about. The vast majority is split between Europe, USA, and Asia. Africa and Latin America only account for about 4% of all identifiable wealth in the world 2020. Yet in their respective soils, the two continents combine to hold perhaps the most resources that humanity will need throughout this century and into the next. So keep your eye on the proxy wars that will be coming about in those two continents between China and Western agents. Global real estate accounts for 280 trillion in wealth, nearly 80% of which is residential. A bit more than 10% is commercial, and about 10% is farmland or agricultural. Total global debt, as of the last IIF global debt report, was at 253 trillion. That's over 3 times the annual gross domestic product of the entire world. It is mostly governments and non-financial corporations that have been gorging on debt since the 2008 global financial crisis, and this trend is unsustainable. Fiat currency supply is typically comprised of 2 aggregate measurements, M1 versus M2, narrow versus broad currency. They basically combine to account for nearly $100 trillion in wealth. Only some 7% or $7 trillion of all this fiat currency value is in physical cash notes. The rest sits in digital accounts on databases as assets and or liabilities, depending on the party that you're talking about. So almost $100 trillion in M1 and M2 combined around the world. Global stock markets account for about $90 trillion in value at the moment, almost half of which is on the U.S. stock markets. About a fourth of all Fortune 500 wealth is now split amongst only 5 companies that you see here. The combined wealth of these 5 companies at the moment represents over $5 trillion in notional value combined. The physical gold market now has nearly 200,000 tons mined and above ground, half of which is in jewelry. A high single-digit percentage resides in industrial applications and within electronics and people's mouths. And over 40% of the rest is split between investor piles and increasingly into government gold bullion vault stashes, which are growing slowly but surely. The world's billionaire class has over 2,000 known members. Their combined wealth is about $8 trillion total. And the Federal Reserve's balance sheet is about to pass them, now sitting above $7.2 trillion, rapidly expanding with no end in sight. There is physical fiat currency cash again. Remember, we mentioned it was about $7 trillion total. And the aforementioned record budget deficit of $3.8 trillion this year, 2020. And then you can see the entire cryptocurrency market totaling nearly $245 billion, 2/3 of which is Bitcoin. And the other now over 5,460 cryptocurrencies make up the remaining $81 billion in values. And finally, we end with the ridiculously small physical silver and bullion market. Visual Capitalist uses the World Silver Survey's transparent silver pile figure, which is basically like 2.5 billion ounces of silver amongst the fractional reserve silver futures exchanges in China, London, and New York COMEX, as well as on silver ETFs and basically transparent silver investment hoards. So they account about 2.5 billion. When you add up private silver bullion that's been bought, especially since 2008 financial crisis, for instance, U.S. Silver Eagles, the silver maple leaves that come out of the Royal Canadian Mint, Austrian Philharmonics, et cetera, et cetera. When you add up all this, you come to a number that's around 4 billion ounces. And probably if you add up even more deep storage private silver, you might get to 5 billion ounces. But just think about it, 5 billion ounces of silver in an investment form or a 90% silver total. That's not even $100 billion. So essentially one of these squares that we've been looking at on this graphic. So it's still a joke in terms of how small it is comparatively. The point is not merely how tiny the physical silver investment market is, but it's also how intertwined silver remains in the psyche of the world. I mean, it's a great brand. People know that silver inherently is more trustworthy and dependable a money than fiat currencies are. And look at what they're doing to the currency system at the moment. It's not going to take much in investor flows to make this silver pile many-fold in the coming years. And once upward price momentum gets going, a pile-on mania can certainly follow. It's happened before in silver, and it likely will happen again. The following silver-related charts are provided by SRS Rocco Report. The first chart illustrates the kind of mines that New Line silver ore comes from. Many copper mines are likely failing due to copper depressed prices, so that could have an adverse effect of bringing new silver to market. While the next chart is going to show how hard primary mining for silver is and how finding new silver ore bodies has gotten more difficult over the last decade and a half. You can see average yield of silver ounces per ton of ground mined has been cut by more than half. Next chart shows how silver mine production has not kept up with gold mine growth, and 2015 was the recent peak for silver production. And by the way, that new silver to gold mine ratio is currently about 7.5, meaning for every 7.5 ounces of silver that are mined, about 1 ounce of gold is mined. So once silver's store of value demand really gets going, it's not hard to rationalize gold-silver ratios back below the 2011 low of 33. The 20 teens, even single digits in a currency crisis mania are possibilities. Finally, here was Steve Sanangelo's work regarding the recent viral mining industry shutdowns we just went through that lasted months of time. We can certainly expect new silver production to be down again this year, 2020. The left side of this chart illustrates silver bullion flows into 4 of the largest silver ETFs in the world. Over 220 million ounces of silver bullion have flowed into these ETFs in the last year or so. That's over 1/4 of a year of new line silver mined. And the right side of the chart, the blue value held line, I suggest is going to be rising akin to its action from 2009 to 2011. And it'll probably lag, but eventually this kind of record silver as a store of value should drive the spot silver price into the cup formation, rerunning back beyond $25 an ounce and then to the 40s as we retest the old silver price highs in the years coming. This time I don't expect we're coming back denominated in fiat Federal Reserve notes again. This Indian silver import chart reminds us that all this is happening without the world's largest silver buyer really taking part. What happens when the Indian market returns and wants its annual plus 200 million ounce swath? At the moment, London silver hoards are being raided, and I'm watching the COMEX to see when this second historic drawdown of silver begins in earnest. Here is what SD Bullion's CEO Tyler Wall had to say this week regarding ongoing silver supply versus demand factors. He wrote, "Major minting operations which supply SD Bullion with privately minted silver rounds and silver bars are now flying in silver from London and Zurich. This is never done in normal markets due to the high cost of transporting silver via planes overseas. Furthermore, one of the largest U.S. refiners has seen a 75% decrease in base silver material coming into its plant from processing versus normal. The main reason they listed is that they're not seeing silver coming in from Mexico due to the mines being shut down. We've received a lot of questions, as you would expect, regarding premiums over the last 3 months. The first wave of premium increases in March and April spiked due to a shortage of readily available minted products. The higher than normal premiums have persisted as mints have been delayed versus the demand for their products. In recent history, this has been the cause of most of the premium spikes and not a shortage of underlying silver. At the peak so far in 2020, major mints were delayed 8 to 12 weeks out. They are now 2 to 3 weeks out. The sentiment in the market is that premiums will decrease if the mints become caught up, so establishments can get closer to just-in-time inventory. Thus, some large players are very likely to have been reducing excess inventory with the hope they will have a chance to reload from the wholesalers/mints at a lower premium. However, one should also take note that a lot of the establishments we work with are operating off a FIFO, first in, first out based accounting system, and setting prices accordingly. By returning to a just-in-time inventory system and combining it with FIFO, price will be based more closely off the cost it now takes to buy these base silver bullion products. They are taking delivery from London and not the COMEX because of the difference in future pricing. It's cheaper to take from London than COMEX and just fly it across the ocean. But that's almost reached an equilibrium by now. Question is, when the silver price begins its monumental climb higher, where will the sources of the store of value silver that's going to be increasingly in demand as a result of the trillions are now the new billions bailout economy we live in? My guess is, judging by this week's poll, many of you are already well positioned for this coming run. And that is it for this week. Thanks for tuning in. Take care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.